all of this contagion fear really leading traders to reprice where the Fed goes from here. Kathleen, what are you seeing?
Well, we're hearing quite loudly from a lot of banks that when it comes to what SVB is doing, where it's pushing the Fed, it's pushing it to think less about more hikes and how big they are, and a lot more about the possibility of a pause, a possibility of a cut. We're seeing those lags, right? Monetary policy lags. Looks like they're catching up with banks. Maybe they didn't catch up with the job market yet, but they have caught up with banks, particularly banks like SVB with so many risky assets on their books. Goldman Sachs, I think, making the easiest call. Their call is the Fed will pause, and then they will do another rate hike, and their terminal rate will be somewhere around 5.25%. Nomura, that's the big star of the day, with their call not only for a cut of 25 basis points, but also halting quantitative tightening for a while, because the Fed, they think, is going to look at the financial stability risk first and foremost, and they are going to say we better cut. Things are unstable. We need to put more liquidity in the system. I think the whole thing about ending quantitative tightening is that they're selling off bonds. I buy a bond, I give you my reserves, I give you the liquidity in the market. You need to keep the liquidity there. That seems to be maybe one of the most solid things they're saying. The cut is very speculative at this point. In terms of BlackRock, though, that's the other bold call, is that the Fed will actually go ahead and do a hike. They're pointing out a very key point, okay? 2008, all the monetary levers were being used to support the economy, and the Fed doesn't have to worry so much about shoring up the whole banking system as it did then. So that's why they have to focus on the 2% target, getting there, continuing to hike rates, bringing down inflation. And they're calling what we're seeing now financial cracks from the rapid Fed hikes. But it's not like 2008 when there were all the mortgage-backed securities that nobody even knew what they were pricing on their books. A very different situation. Now, also interesting, Larry Summers, former Treasury Secretary, Bloomberg opinion columnist, saying in an interview today with our own David Weston that a pause would actually be a mistake by the Fed. Let's listen.
My own judgment is that it would be a serious mistake for the Federal Reserve not to remain focused on its objective of containing inflation and bringing it down to the range of the 2% target, and that's probably going to require monetary policy to become more restrictive than it is right now.
Very important. Two things we're focused on, besides what's happening in the banking system with the bailout from the Treasury, with the Fed's new lending facility. We're looking at consumer prices tomorrow. More emphasis on ever on the February consumer prices, expected to come down the headline from 6.4 to 6. On the core, 5.6 to 5.5, a little bit of improvement. A big move in either direction could be important for these very volatile markets. And also the European Central Bank meets this week. They've been pushing hard for a 50 basis point rate hike. No comments from the ECB yet. I think a lot of analysts and economists are saying that they don't have an impact like we're having in the US. They can go ahead and do 50, but it's another question for the markets as we go through the week.